So here we can see the weekly chart of the euro dollar. We have discussed it already a bit, saying that last week the euro dollar ran into significant resistance created by 100-week moving average. Then we come to the daily chart, and here we can see also some varying signals. Some signals that we will see further declines of the pair. We can see that the euro dollar on Friday formed a bearish candle, which is actually a bearish outside engulfing candle, and is a rather strong bearish signal. The pair also closed below the support line, which is connecting July and August minimums, and now we can see that it is holding below the level of 100-day moving average, just above 1.12 mark. It is a line painted in green on this chart. So it is quite reasonable to expect further downside of the single currency versus the US dollar. However, in my opinion, this downside won't be very big. We won't see a big sell-off of the euro. We can see that the daily moving average, 100-day moving average, this 50-day moving average, and 200-day moving average are almost horizontal, which means that the general market lacks strong direction. It means that the pair is consolidating around these levels and won't make some really volatile moves. On the 4-hour chart, we can see that a kind of triple top was formed during the past 2 weeks, and the levels which used to be a support and around 1.1250 and 1.1230 represent now a significant resistance for the euro dollar. And I think that if an increase to these levels materialize in the coming few days, this area will be a good area to enter bearish positions for the euro dollar. We can see that the pair has support. Support is at 1.11 mark. This is actually 50-week moving average at the weekly chart. So this is the target I have as for selling the euro, as I think that it may be hard for the bears to overcome this support area. So here is our working range for the euro dollar this week. It is 1.1250 and 1.11, probably not much, but I am continue sticking to the view that we won't see very strong, very volatile moves. So we will trade on the breakthrough of this support line at 1.1150. Here is 200-day moving average at the 4-hour chart. I find that the combination of these moving averages, 200 period, 100 period, and 50 period, works the best at actually all price time frames for forex measures, as these are the main lines followed by most of the traders. And here market psychology plays its role, because if all traders see these important lines, then they react to these lines, they build their trades on the basis that the pairs will either recoil from these lines or break these lines. In any case, traders do notice these lines, so they are really important, and they do provide good hints for the market. All in all, I think that the picture for the euro dollar is quite clear. If you already have short positions for the euro, you may hold them ahead of the US data on Friday. If you don't have them, then look for more attractive levels, either higher in the resistance area I've mentioned or on the break of support. I think that it would be better to close positions ahead of NFP release, just ahead of this on Friday, or when the euro dollar hits this target area of 1.11, and then to conduct another set of market analysis, another set of technical analysis. As for the fundamental picture for the euro, it lacks the fundamental strength of its own. There will be data from Germany this week. Germany will release inflation figures today. So far, data from different regions of Germany showed that consumer prices have either contracted or haven't changed. So I think that the overall reading for German CPI will be also weak. And this might have an impact on the euro area's consumer prices, which will be released on Wednesday. So European factors don't support the euro as well, in my opinion. Euro is currently correlated positively with the market risk sentiment. So maybe there will be some hints for the euro dollar from that, but of course the theme of divergence of the European Central Bank and the Federal Reserve's monetary policy should be the main driver of the euro dollar, at least until Friday, until non-farm payrolls. If, as I expect, we don't get any clear signal from non-farm payrolls that there will be a rate hike in September in the United States, then the euro might find support in the mentioned levels around 1.11, maybe a bit lower in the 1.10 area. As we can see that all in all, the euro is rather resilient despite the easy monetary policy of the European Central Bank. It is partly caused by the fact that the euro area has a big current account surplus. European banks with their troubled balances now don't export capital much, and this creates this diminishes monetary outflow of the euro area, creates monetary inflow and support the euro, and this situation is not going to change fundamentally. So if we don't get a serious signal from the monetary policy divergence, then the euro dollar may stick to this support levels around 1.11 and continue its sideways trading somewhere between 1.10 and 1.12 in the coming weeks. But for this week, I have outlined the prospects.